Welcome to the Deep Dive. We are so glad you're joining us for another exploration into a topic that, frankly, can feel a bit like decoding a secret language.
Definitely. Today, we're pulling back the curtain on finance.
It's a world often seen as complex, numbers-driven,
Mm-hmm.
maybe even intentionally intimidating sometimes.
Yeah, and that intimidation factor is real for a lot of people. But the sources you've provided for this deep dive, especially the insights from Mihir Desai's book, How Finance Works, well, they really aim to change that narrative.
Exactly. Our mission today is to take this stack of material you sent over and, together, really extract the absolute most important nuggets. The key stuff.
Right. The goal isn't to have you memorizing formulas or anything like that. It's about building your intuition, giving you kind of fundamental understanding.
So you can approach financial discussions, financial decisions with more confidence and maybe even some curiosity.
Precisely. Think of this as a guided tour. I'll be pointing out some of the, surprising facts, the analogies that really click, the bits from the text that jump out.
And I'll be adding context, helping connect the dots between the principles and really showing how it all fits together and why it matters in the real world.
Okay, let's do it.
So let's jump right in. The source material wastes no time at all addressing that feeling people have that finance is this big mystery.
Yeah, it suggests that for many people, finance feels cloaked in a kind of deliberate obscurity.
Deliberate. You think so?
Well, the source implies that maybe, just maybe, some folks within finance don't exactly mind that. It can be used to, intimidate outsiders a bit.
Which is such a shame, because the source immediately pushes back hard on that. It argues that understanding finance is absolutely vital. Crucial, even.
It calls it the lifeblood of the economy. That's a pretty strong statement.
It is. And it goes further, saying it's become essential for professional growth in, almost any field these days.
Right. The book excerpts really hammered this point home. If you want to move forward in your career, whether you're a lawyer, a general counsel, an executive, whatever you have to engage with finance, you just can't avoid it.
And this material we're looking at, it seems specifically designed to make finance accessible, but without, dumbing it down.
Exactly. It focuses on building that core intuition, lots of diagrams, real-world examples. It actively tries to steer clear of getting bogged down in endless equations or the source calls Mickey Mouse numerical examples.
Mickey Mouse examples.
I like that.
So it's aiming for rigor, but without the unnecessary complexity.
That's the idea. Rigor without the pain, maybe?
And the only real prerequisites mentioned.
Curiosity and perseverance. And frankly, by bringing these sources to us, by wanting to do this deep dive, you've already shown you have both of those.
Okay, so let's get to the heart of it. What's the absolute core takeaway right at the very start? The most fundamental idea everything else builds on.
I'd say the single most powerful idea here, the one that really reframes everything, is that finance, at its core, isn't just about the numbers or reading balance sheets.
Okay, so what is it about then?
It's fundamentally about information and incentives, and it's trying to solve what the source terms, quite dramatically, capitalism's fundamental problem.
Capitalism's fundamental problem. Wow, okay. That sounds significant. What exactly is that problem?
It boils down to the principal-agent problem. It comes from the way modern companies are set up, where ownership is separated from control.
Right. The owners are the shareholders, they're the principals. But the control is with the managers, they're the agents.
Precisely. Think about it. You might own some shares in, say, Microsoft. You're a principal, an owner.
Right, a tiny owner.
But you're not Satya Nadella, the CEO. He's the agent making the day-to-day and the big strategic decisions.
Okay, got it. So how do I, as that tiny owner, know he's actually acting in my best interest, the owner's best interest?
That's the million-dollar question, or maybe $1 trillion these days. You don't have perfect information about everything he knows or does. That's called asymmetric information.
Asymmetric information, okay.
And he, the agent, might have his own incentives. Maybe he wants to grow the company really big, even if it's not the most profitable strategy. Or maybe focus on things that give the stock a quick bump rather than long-term value.
Ah, I see. So there's this potential conflict.
Exactly. This fundamental tension, this challenge of how to align the interests of the owners, principals, and the managers, agents, when information isn't perfect and incentives might differ. That is the constant puzzle finance tries to solve. It's a theme that pops up again and again.
Wow. Okay, framing it like that, It suddenly feels much more human. It's not just abstract numbers. It's about people and their motivations.
It really is. And understanding this dynamic information, incentives, the principal agent problem, that's the bedrock for understanding everything else.
So the source material then kind of lays out a path to explore this world, right?
Mm.
Which gives us our roadmap for this deep dive.
Yep. We'll look at the language of finance, that means ratios, then the specific finance perspective, its obsession with cash and the future. Then the whole ecosystem, the players involved and the problems that arise there.
And after that,
How value is actually created, the art and science of valuation, figuring out what something's worth. And finally, this really critical decision companies face, what to do with their cash, which is called capital allocation.
okay, that's a lot to cover. And for you, our listener, the reason this first part matters so much, why the book starts here.
It's because getting past that initial intimidation, grasping this fundamental problem, that finance is really about people, information, incentives. It gives you the confidence, the intellectual framework to make sense of all the details that follow.
It turns rows of numbers into a story almost.
A story about human behavior and organizational challenges, exactly.
Okay, great start. Let's take that framework now and dive into the actual language finance uses to describe companies. Financial analysis, mainly using ratios. This is where Chapter 1 starts building that intuition.
Right. Financial analysis is basically using a company's reported numbers to figure out how it's doing, its financial health, its business model.
And the source kicks this off with a really clever approach, doesn't it? It asks you to play a game.
Yeah, the ratio game. Trying to identify real but anonymous companies just by looking at a handful of their financial ratios.
I love that.
Yeah.
Because it forces you to think about what the numbers mean.
Exactly. It's brilliant. You see a company with, say, really high inventory turnover and very low receivables, and you immediately start thinking, must be selling things fast and getting paid up front. Maybe fast food or a certain kind of retailer.
Right. They mentioned the game includes anonymized versions of companies like Starbucks, Amazon, Netflix, Walgreens, UPS, all these familiar names. You look at their financial fingerprints, the ratios, and try to guess who's who.
And to get those ratios, you need the basic financial statements. The source starts, logically, with the balance sheet.
The balance sheet. That's a snapshot in time, right? What a company owns its assets and how it paid for those assets, its liabilities, and shareholders' equity.
And the fundamental equation holds. Assets, liabilities, plus shareholders' equity. It always has to balance.
The source uses a personal analogy which helps. Your assets are your stuff. Cash, car, house. Liabilities are your debts. Car loan, mortgage. Equity is your net worth.
Simple but effective. On the company's asset side, you've got things like cash and marketable securities. The source mentions Apple's famous mountain of cash, over $250 billion at one point.
The accounts receivable. That's money owed to the company, right?
Yep, by customers who bought stuff but haven't paid yet. Common in business-to-business sales where they offer payment terms 30, 60, 90 days.
And that ratio game highlights one company, Company N, where receivables were a huge chunk of assets, a majority.
Which immediately tells you something's different about their business model. Maybe they have a big financing arm, or they sell very high-ticket items with long payment plans. Totally different from companies B, H, and I, which had almost no receivables, likely selling direct to consumers who pay immediately.
Then you have inventory. Goods waiting to be sold, like everything on the shelves at Kroger or Walgreens.
Or the source uses Haagen-Dazs ice cream sitting in freezers is obviously central to their business. It's inventory.
And property, plant, and equipment, PP&E, the physical assets, buildings, machines, land.
The source contrasts high PP&E companies, like maybe a traditional retailer with lots of stores, Walgreens, Kroger, with potentially lower PP&E businesses like, say, Amazon, company A in the game. Amazon might rely more on massive fulfillment centers and data centers, which could be structured or accounted for differently than traditional stores.
One really fascinating point the source makes is about intangible assets, things like brand value.
Oh, yeah, this is wild. Internally developed brands, like Starbucks, often have a book value of 0 on the balance sheet according to strict accounting rules.
0. But Forbes estimated the Starbucks brand was worth over $154 billion.
Exactly. It shows this huge gap between accounting numbers and real-world market value. Accounting is conservative here.
But wait, the source says sometimes intangibles do show up.
Right. When one company buys another, the amount paid above the value of the tangible assets gets recorded as goodwill. That's how acquired brand value, customer lists, etc., finally get an accounting number because cash was actually paid for them in a transaction.
Okay, that makes sense. So on the other side of the balance sheet, liabilities and equity, how the assets are financed.
Liabilities are what the company owes, mostly different forms of debt. Shareholders' equity is the owner's stake, the net worth of the company on the books.
And the mix between debt and equity, that's the capital structure. The source shows it varies wildly. Company G, mostly equity. Company N, mostly debt. Different industries, different risks, different financing approaches.
So the balance sheet is the snapshot. To see how things change over time, we need the income statement.
Which tracks performance over a period, like a year. Shows revenues, costs, and ultimately profit. The Starbucks example in the source breaks this down.
And from these two statements, we derive ratios. They combine numbers to provide insights. The source calls them the language of business.
Let's break down a few key types. First up, liquidity ratios.
These ask basically, can the company pay its short-term bills? The current ratio, current assets, current liabilities, is a big one. A supplier wants to know if there are enough easily convertible assets to cover what's owed soon.
And the quick ratio is similar, but it pulls out inventory.
Yeah, because inventory might not be convertible to cash quickly. You might have to sell it first, maybe even at a discount. So the quick ratio is a stricter test of immediate liquidity.
Higher liquidity is good for suppliers, but maybe not always the best for shareholders.
Could be. Holding lots of cash, very liquid, might mean that cash isn't being invested in potentially higher return projects. It's a trade-off.
Okay, next, profitability ratios. How good are they at making money?
Profit margin, net profit revenue is a key one. How much profit falls to the bottom line for every dollar of sales?
The source has that great contrast. Intel, turning sand into super valuable microchips, likely high margin, versus a grocery store like Food Lion, mostly distributing products made by others, likely much lower margins.
Perfectly illustrates how margins reflect the business model and value add.
And return on equity, ROE, net profit divided by shareholders' equity.
That's a huge one for owners. It measures the profit generated for every dollar they've invested in the company. It's a direct measure of shareholder return from the company's operations.
Then there are productivity or asset turnover ratios, measuring efficiency.
Right. How effectively are assets being used? Inventory turnover, cost of goods sold average inventory, shows how many times inventory is sold and replaced per year.
Company H in the game turned its inventory 32 times a year. That's like every 11 days.
Screams fast food, right? Like Yum, Brands, KFC, Taco Bell. Contrast that with a department store like Nordstrom holding fashion items much longer, or a utility like Duke Energy, where electricity can't really be inventoried at all.
Receivables collection period, receivables sales. How quickly do they get paid on credit sales?
Lower is generally better here. You want that cash fast. Remember Company N with its 20-plus year collection period, something very unusual there. Compare that to Company M, maybe Southwest Airlines, getting cash instantly from consumers versus Company E, perhaps UPS, selling to businesses on credit, leading to longer collection times. The ratios really paint a picture.
Lastly, leverage ratios. How much debt are they using?
Measures like assets to equity or debt to assets. Using debt, other people's money, lets you control more assets and potentially amplify your ROE.
But it's a double-edged sword, right? It also magnifies losses and increases financial risk. If things go bad, debt payments still have to be made.
Absolutely, which is why companies targeted for leveraged buyouts, LBOs, where a buyer uses a ton of debt to acquire the company, tend to be those with very stable, predictable cash flows.
Like tobacco, gaming, maybe utilities. Businesses where demand doesn't fluctuate wildly, they can handle higher debt loads.
Exactly. The source then introduces the DuPont analysis, which is neat. It breaks down ROE.
ROE, profit margin X, asset turnover X, financial leverage.
It shows that a high ROE can come from different sources. You can be highly profitable or turn over assets really fast or use a lot of debt or some combination. It helps you dissect where the performance is coming from.
And the Timberland example uses this brilliantly to tell a story, doesn't it?
It's a fantastic case study in the source. The CEO claims things are great. ROE is near the industry average, 11.9%, then is 12.3%. Looks okay on the surface.
But the DuPont analysis reveals the truth.
Right. The ROE wasn't driven by strong profitability. Their margin was low. It was coming from high asset turnover and high financial leverage. They were selling things fast and were heavily indebted.
And then they dug deeper into the leverage.
Looked at the times interest earned ratio. TIE equals operating profit interest expense. It had plummeted from over 3 to less than 1.
Meaning operating profit wasn't even enough to cover the interest payments on their debt.
Exactly. The source calls it a near-death situation. They were technically insolvent from an operating perspective.
So how did the ratios show their reaction?
Inventory turnover spiked even higher, while gross margins dipped. That pattern points clearly to one thing.
A fire sale. Dumping inventory at lower prices just to generate cash, desperately needed to pay the bills and service the debt.
Precisely. It's a survival move revealed entirely through the ratios over time.
And this connects back to that core theme, doesn't it? The principal-agent problem.
Absolutely. The manager, CEO, might present the single positive ROE number, trying to paint a rosy picture, while the underlying ratios reveal a much more troubled reality. It highlights that information asymmetry owners face. Managers control the narrative.
So the big takeaway from this whole section on ratios, they are the essential language. They let you look under the hood, analyze performance, health, business models, even strategy and challenges over time, like with Timberland.
And for you, our listener, understanding these basic ratios and how they connect gives you the power to read a company's numbers, ask smarter questions, and not just take headline numbers at face value. You can start playing that ratio game yourself.
Okay, fantastic. We've learned the language. Now let's shift gears to what the source calls the unique finance perspective. Chapter 2 argues finance is obsessed with two core things: cash and the future.
That's right. While accounting often focuses on net profit, the finance world tends to prioritize cash flow.
Why the difference? Why is net profit the whole story for finance?
Well, net profit mixes cash and non-cash items like depreciation. It reduces profit on paper, but no cash actually leaves the building. Also, net profit is calculated after deducting interest payments, a financing cost, and taxes. Finance often wants to look at the cash generated by the core operations before considering the specifics of how the company is financed or taxed, and it wants to isolate the cash truly available after all necessary reinvestments.
So the source lays out a sort of hierarchy of cash measures.
Yeah, it builds up, starting with EBITDA earnings before interest, taxes, depreciation, and amortization.
EBITDA. You hear that one thrown around a lot.
It strips away the financing costs, interest, taxes, and those major non-cash charges, depreciation, amortization, to give a cleaner picture of the cash generated from basic operations.
The Amazon 2014 example in the source is perfect for this. They reported a net profit loss of $241 million that year.
Which sounds bad, right?
Right.
But if you calculate their EBITDA based on the numbers provided, gross margin minus operating expenses plus depreciation hidden in COGS, it was a positive $4.9 billion.
Wow. So losing money on the bottom line, but generating almost $5 billion in cash from operations before those other items.
Exactly. It showed the underlying business engine was humming along, generating substantial cash, even if accounting rules, heavy investments, and other factors led to an accounting loss. Focusing only on net profit would completely miss that operational strength.
Okay, so EBITDA is step one. What comes next?
Operating cash flow, OCF. This adjusts EBITDA for changes in working capital, things like inventory buildup or collecting receivables slower or faster.
Working capital changes affect cash, right? If inventory goes up, you spent cash. If receivables go up, you haven't collected cash yet.
Precisely. OCF captures that. And then the ultimate measure for many in finance is free cash flow, or FCF.
Free cash flow, what makes it free?
It's typically operating cash flow minus capital expenditures, CapEx, the money spent on maintaining and expanding long-term assets like factories, equipment, data centers.
So it's the cash left over after running the business and making necessary investments for the future.
Exactly. It's the cash truly available to all the company's capital providers, both debt holders and equity holders. The source calls it finance nirvana. It's the cash the company generates that could theoretically be paid out without harming the business's ongoing operations or future prospects. Note it's typically calculated on a tax-adjusted basis.
And the source mentions finance's focus has shifted over decades, moving from revenue to profit, and now really centering on free cash flow. Figure 2.4.
Yeah, FCF is widely seen today as the best measure of a company's economic value generation.
Let's circle back to working capital for a second. Current assets minus current liabilities.
Yeah.
You mentioned it affects operating cash flow.
Right. The key components are receivables, money owed to you, inventory, stuff waiting to be sold, and payables, money you owe to suppliers. These drive the cash conversion cycle.
Ah, yes, the cycle. Days inventory plus receivables collection period, payables period. How long it takes from paying your supplier to getting cash from your customer.
It's the time your cash is tied up in the operating cycle. The source calls it the funding gap because you generally need to finance that period.
The hardware store analogy in the book is simple but clear. Buy hammer, pay supplier. Hold hammer, inventory days. Sell hammer, creates receivable. Collect cash, receivables days. That whole time lapse needs funding.
What's the cost of funding it? Depends on where the company gets its money, bank loans, equity, etc.
The source has that fantastic example about managing payables. The supplier offering a 2% discount if you pay in 10 days instead of the usual 30.
That 20-day difference is key. If you don't take the discount and pay on day 30, that 2% you forego is effectively the interest the supplier is charging you for borrowing from them for those extra 20 days.
And when you annualize that, 2% for just 20 days, it works out to a ridiculously high annual interest rate, over 36%.
Exactly. The source's point is stark. Would you rather pay an implicit 36% plus annual rate to your supplier or borrow from a bank at, say, less than 1%, implied in the example's comparison, to pay early and grab that discount?
It's a no-brainer. Take the discount, borrow from the bank if needed. It shows how actively managing working capital, like payables, can be a source of cheap financing.
And then you have Amazon, which takes this to a whole other level with its negative cash conversion cycle, averaging negative 23 days in 2014.
Negative? How does that even work?
They collect cash from customers extremely quickly, often immediately, low receivables days. They stretch out payments to their suppliers, high payables days, and they manage inventory very efficiently.
So they get cash in before they have to pay cash out.
Essentially, yes. Their working capital doesn't consume cash, it generates cash for them. Figure 2.7 in the source shows this negative cycle acting like a source of financing, fueling their growth and investments, contributing to that positive OCF even in years with net losses.
That's incredible. It's like their suppliers and customers are funding their operations.
To a significant extent, yes. Now, the source does clarify that in 2014 specifically, the change in working capital actually used some cash because the cycle got less negative improved, meaning it provided less cash than the year before. But the overall negative cycle is a huge advantage.
Comparing Amazon and Netflix using these cash flow metrics, figures 2.7, 2.8, is really revealing.
Totally. Netflix often looks profitable based on net profit, but their operating cash flow and free cash flow are consistently deeply negative.
Why the huge difference?
Because they spend enormous amounts on creating content, new shows, movies. While accounting rules might spread that cost out over time, capitalizing it, the cash goes out the door now. It's like massive ongoing capex in spirit. So despite accounting profits, they constantly burn through cash and need external funding.
Amazon.
Strong positive operating cash flow usually, thanks partly to that negative cash cycle. But they also spend huge amounts on CapEx, AWS data centers, fulfillment warehouses, buying Whole Foods, so their free cash flow can sometimes dip negative too, depending on the investment intensity in a given year.
So the key insight here is,
different measures tell different stories. You can't just look at profit or revenue. Cash flow reveals the liquidity reality the investment needs. For Netflix, the big question is how they keep funding that content spend. For Amazon, it's how they balance massive investment with cash generation.
okay, so cash is king. What's the second obsession of finance, according to Chapter 2?
The future. And the fundamental principle that money today is worth more than the same amount of money received in the future. The time value of money.
Right, because you could take the money today and invest it.
Exactly. That's the opportunity cost. If you get $1,000 a year from now, you lose the return you could have earned by investing it for that year.
So finance needs a way to compare money across different time periods. That's discounting, right?
Precisely. Discounting is translating a future cash flow back to its equivalent value today. The source explains, if you want $1,000 in 1 year and can earn 10% interest, you only need to deposit $909.09 today.
1,000%.
But if you can only earn 2% interest, then you'd need to deposit $980.39 today, 1,001.02. A higher interest rate or discount rate means future money is worth less today because the opportunity cost of waiting is higher. You're giving up more potential earnings.
The formula is basically future cash flow divided by 1 plus discount rate, raised to the power of the number of years away, CF 1 plus RT.
Yeah. The source calls it putting a haircut on future cash flows. The further out the cash flow and the higher the discount rate, the bigger the haircut.
And the present value, PV, is just the sum of all those discounted future cash flows.
Correct. And that leads directly to the most fundamental decision rule in finance, net present value, or NPV.
NPV of future cash flows initial investment cost.
And the rule is simple but profound. Only invest in projects with a positive NPV. Because a positive NPV means the present value of the expected future benefits, cash inflows, is greater than the present value of the costs, initial investment. It means the project is expected to create value for the owners above and beyond the required rate of return, represented by the discount rate. Negative NPV means value destruction.
This ties into the sunk cost concept, too, with the Nike factory example.
Yes. Nike spent $75 million building a factory. That money is gone. It's sunk. Irrelevant to the decision now.
Now they have a choice. Sell the factory today for $40 million or keep operating it, and the PV of the future cash flows from keeping it is estimated at only $10 million.
The $75 million spent is history. The decision today is purely $40 million cash now versus $10 million PV later.
Sell it for $40 million. Even if building it was a bad initial decision, implied negative NPV back then.
Exactly. Decisions are always about the future, based on incremental costs and benefits from this point forward.
The Sharp LCD plant case adds another wrinkle. They built it for $3 2Bs, likely negative NPV, then sold 46% to Terry Gu's company for $780, implying a total value for the plant of only $1 7Bs.
The source suggests this $1 7B was less than the plant's true value at the time, implying the PV of its expected future operating cash flows was actually higher than $1 7B, even if less than the original $3 and 2B cost.
So double whammy. A bad decision to build, then another bad decision to sell it too cheaply.
Looks like it, based on the source's interpretation. Poor capital allocation decisions.
Okay, so the big takeaways for the finance perspective. Cash is the critical measure, FCF, and the future matters immensely, requiring us to discount future cash flows back to their present value using an appropriate discount rate. NPV is the decision key.
Absolutely. These two concepts, the primacy of cash and the time value of money, are the foundation for almost all financial analysis, valuation, and investment decisions. Understanding them lets you evaluate opportunities, personal or business, through a rational financial lens.
Right. A dollar today is not the same as a dollar tomorrow. That sinks in. Okay, we've covered the numbers and the core finance perspective, but finance isn't just math, is it? It involves people, institutions, relationships.
Exactly. Which brings us to Chapter 3 in the source material, the financial ecosystem. This dives into the players and brings us right back to those core themes of information and incentives and that persistent principal-agent problem.
So who are the key players in this ecosystem? The source starts with the equity research analyst.
Yeah, think of them as guides, or maybe critics. Their job is to analyze companies, forecast their performance, estimate their value, and make recommendations buy, sell, or hold. They spend a lot of time talking to company management, gathering information.
Okay, so analysts are trying to figure things out. Who are they providing this research to?
Primarily the buy side. These are the institutional investors, the ones with huge pools of money who actually buy stocks, bonds, and other assets.
Who falls into this buy-side category?
The source lists several major types. You've got mutual funds, which pool money from lots of small investors to buy a diversified portfolio. Pension funds, managing retirement savings for workers. These can be huge.
Like CalPERS or something.
Exactly. Then foundations and endowment funds, like university endowments. Harvard's massive $37 billion fund is mentioned. They invest for the very long term to support their nonprofit missions. Sovereign wealth funds, which are state-owned investment funds, like Norway's famous trillion-dollar-plus fund built from oil revenues.
And hedge funds. They seem different.
They are. Hedge funds are typically less regulated, cater to sophisticated or wealthy investors, and often use more complex strategies, including leverage, borrowing to invest more, and short selling. They play a significant role, often taking more concentrated or activist positions.
The source emphasizes the rise of these institutional investors as a huge deal in modern capitalism, right? They control vast amounts of wealth now.
Absolutely. Individual investors are still important, but the sheer scale of institutional capital shapes markets.
And for many on the buy side, especially mutual funds, diversification is key.
Yes, the source calls diversification the only free lunch in finance, referencing figure 4-4. By holding a wide variety of stocks or assets that don't move perfectly together, you can reduce the overall volatility or risk of your portfolio without necessarily sacrificing expected return.
How does that work?
Bad news hitting one company, its stock drops, might be offset by good news for another, its stock rises. The company-specific ups and downs tend to cancel each other out in a large portfolio, leaving you mainly exposed to broader market movements.
But hedge funds often don't diversify as much.
Right. They often take concentrated bets, maybe becoming activist investors trying to force changes at a company. They manage risk differently, sometimes through actual hedging.
Like the example in the source, figure 3-4. Buying Merck stock but shorting Pfizer stock.
Exactly. If you think Merck will outperform Pfizer, but you're worried the whole drug sector might fall, you could go long Merck and short Pfizer. Your bet is then on their relative performance. If the whole market tanks, your loss on Merck might be offset by the gain on your Pfizer short position. You've hedged away some market risk to isolate your bet on the company's specifics.
Okay, so that's the buy side. What about the sell side?
These are the institutions that help companies sell securities or provide financial services to companies and investors.
Like investment banks.
Primarily, they help companies issue new stock or bonds managing initial public offerings. IPOs is a big one. The source mentions Facebook's huge IPO managed by giants like Morgan Stanley, JP Morgan, Goldman Sachs. They also advise on mergers and acquisitions, M&A.
Yeah, and broker-dealers.
They facilitate the actual buying and selling of securities for clients, executing trades in the market.
So you have the buy-side investors, the sell-side banks, brokers, the companies themselves, and the analysts trying to bridge the information gap. Where do the problems, the information, and incentive issues arise in their interactions?
Oh, everywhere. It's woven into the fabric of the system. The principal agent problem is constantly lurking. Owners, shareholders, versus managers. How do you align their interests?
Companies give managers stock options, right, to make them think like owners.
They do, and that's the intent. But it can have unintended consequences. It might incentivize managers to focus on short-term stock price bumps, maybe even manipulate earnings rather than long-term value. And then there are questions about when executives sell their own stock, does it signal something?
What about boards of directors? Aren't they supposed to represent the owners and monitor management?
In theory, yes. But the source points out that management often has significant influence over who gets nominated to the board. So are boards always truly independent watchdogs? It's debatable.
And that asymmetric information problem, managers knowing more than outsiders, is always there.
Always. Managers have the inside track on how things are really going. Investors and analysts are always trying to piece together the picture from the outside, relying on imperfect signals.
This asymmetry, combined with incentives, seems to explain the analyst bias the source talks about. Why are sell ratings so rare?
The incentives often push analysts towards optimism. Firstly, they need access to company management to get information for their research. A negative rating can get you shut out.
The information flow gets cut off.
Exactly. Secondly, the analyst's firm, the investment bank, often wants to win lucrative business from the company being covered, like managing their next stock offering or advising on an acquisition. A sell rating doesn't help win that business.
So subtle pressures to stay positive.
It seems likely. Analyst rankings also create incentives. Do you work hard for accurate forecasts, just follow the herd, or make really bold, possibly wrong calls to stand out?
And this connects to why markets can react so violently to small earnings surprises, like a company missing its earnings forecast by just a penny causing the stock to tank.
Yes. The source explains it's not just the penny miss itself, it's the signal it sends. It raises doubts about management's credibility. Did they know things were worse? It makes investors wonder what else they don't know. Is this the tip of the iceberg? That asymmetric information amplifies the reaction. Fear of the unknown takes over.
So CEO credibility is a huge asset in the financial markets.
Absolutely. Losing investor trust is incredibly costly. Managers have to carefully manage expectations. Overpromising and underdelivering is dangerous.
The Sharp LCD plant sale to Terry Goo's company is revisited here too, right, as a potential conflict of interest.
Yes, the source brings it up again in this context. Gu was a director at Sharp, but also the head of the company, buying a major asset from Sharp, potentially quite cheaply. While maybe not illegal, the source contrasts it with a Dell case where management was cleared. Market observers definitely question whether Sharp's shareholders got a fair deal or if Gu's dual role created an agency problem where he benefited at their expense. These dynamics are complex. The source uses a detailed case study to illustrate how some players navigate this. The leveraged buyout, LBO, of Topps Friendly Markets by Morgan Stanley Private Equity.
Right, Morgan Stanley PE buys Topps, a supermarket chain, using mostly debt and LBO.
The LBO rationale. Leverage boosts returns if things go well, and supermarkets are often targeted because their cash flows are relatively stable. People always need groceries.
What problem did Morgan Stanley see at Tops?
They viewed it as a corporate orphan, neglected by its large, distant parent company, Royal Ahold. The connection to local customers was lost. Operations weren't optimal. This is essentially an agency problem. The parent principal wasn't effectively overseeing the subsidiary agent.
So how did Morgan Stanley, as the new owners, principals, address this?
They brought back the former top CEO, Frank Kersey, who knew the business inside out. They empowered him to fix operations, leveraging his specific knowledge. This shows the private equity firm acting as a very active owner, intervening directly to improve management and strategy.
They reduced the agency problem by changing the agent and actively monitoring.
Precisely. They used financial analysis to confirm the stable cash flows needed to support the debt. They worked closely with Kersey's team, reducing the information asymmetry.
And the high leverage. 96% jet to assets mentioned.
Hugely risky on paper, but they judged the stable supermarket business could handle it, especially with the planned operational improvements like investing in store infrastructure, giving local managers more flexibility, reconnecting with customers.
The goal being
Fix the operations, improve cash flow, maybe pay down some debt, and then sell the company later for a profit, either back to the public markets via an IPO or to another company.
So the big takeaway from exploring the ecosystem, it's a web of players with different roles, information levels, and crucially, different incentives. Understanding the principal agent problem and asymmetric information helps explain so much market behavior, analyst recommendations, and corporate decisions like LBOs.
And for you, our listener, this context is vital. When you read about a merger, an IPO, an activist campaign, you can now think beyond the headlines and ask, who are the players? What are their likely incentives? What information might they have or not have? It adds a crucial layer of critical thinking.
Okay, this is making sense. We understand the language, the core finance perspective, the players, and their incentives. Now let's get to the fundamental question. How do companies actually create value for their owners? What's the engine of wealth? That's chapter 4.
This is really the heart of it, and the source boils it down to one absolute critical principle, the sine qua non, it calls it.
Which is?
A company must earn a return on the capital it invests that is greater than its cost of capital.
Return must be greater than the cost. Sounds simple enough.
Simple in concept, but everything hinges on it. The source puts it very bluntly. If a company's return on capital only equals its cost of capital,
Nothing else matters. The company's not creating value. You could have stayed in bed. I remember that line. It's stark.
it really cuts through the noise, doesn't it? Earning just enough to pay back your investors for the risk they took isn't creating new value. It's just meeting expectations. Value creation happens when you exceed that hurdle.
And that cost of capital for the company, it's directly related to the return demanded by its investors, right?
Exactly. The expected return investors require becomes the cost of capital managers have to overcome.
We touched on this earlier. Debt investors demand a lower return because their investment is generally safer. Fixed payments, priority if things go bankrupt. Equity investors demand a higher return because they bear more risk, paid last, only if profits are made.
And that required return for equity holders is all about risk. Investors are generally risk-averse. They need to be compensated for taking on risk. The higher the perceived risk, the higher the return they demand.
So how does finance measure the risk that investors actually care about, the risk they demand compensation for?
The key insight, especially for large, diversified institutional investors, is that they mainly care about systematic risk.
Systematic risk. What's that?
It's the risk that's correlated with the overall market or economy. Risks you can't diversify away just by holding lots of different stocks. Think broad economic downturns, interest rate changes, geopolitical events, stuff that affects almost everyone.
What about company-specific risk, like a key drug failing trials for a pharma company?
In a well-diversified portfolio, that company-specific or unsystematic risk tends to get washed out. Some companies have bad news, others have good news. So finance theory argues investors don't get compensated for bearing risks they could have easily diversified away. They only get compensated for the systematic risk they can't avoid.
And the measure for that systematic risk is beta.
Yes. Beta measures how sensitive a particular stock's returns are to the movements of the overall market.
So a beta of 1 means the stock tends to move in line with the market.
Roughly, yes. If the market goes up 10%, a beta 1 stock is expected to go up around 10%. A beta greater than 1 means it's more volatile, tends to amplify market movements, riskier. Beta less than 1 means it's less volatile, less risky.
What about a stock that moves against the market? Like the gold example in the source, figure 4 to 8.
That would have a very low, maybe even negative beta. Assets like that can act like insurance in a portfolio, potentially lowering overall risk, and might therefore have a lower required return despite their own volatility.
Okay, so beta captures the systematic risk. How does that feed into the cost of equity?
Through the capital asset pricing model, or CAPM. It's a foundational model in finance.
CAPM, what's the formula?
Cost of equity risk-free rate plus beta market risk premium.
Let's break that down. Risk-free rate.
That's the theoretical return on an investment with zero risk, usually proxied by government bond yields.
Beta, we just discussed the measure of systematic risk.
And the market risk premium is the extra return investors, on average, expect to earn from investing in the overall stock market compared to the risk-free rate. It's the compensation for bearing average market risk.
So the riskier a stock, higher beta, the higher its cost of equity, because investors demand more compensation.
Precisely. The source shows AIG, in a historically higher beta industry, having a higher estimated cost of equity than Yum. Brands, lower beta fast food industry, figure 4 to 9. Investors need a higher expected return to hold AIG stock because it's perceived as more sensitive to market swings. This relationship is often called the security market line.
Okay, so that's the cost of equity. What about the overall cost of capital for the company, considering it uses both debt and equity?
That's the weighted average cost of capital, or WACC. It's simply the average of the cost of equity and the after-tax cost of debt, weighted by their respective proportions in the company's target capital structure.
So WACC is the blended hurdle rate for the company's overall investments.
Generally, yes. It represents the minimum return the company needs to earn on its overall asset base to satisfy all its investors, debt and equity. It's often used as the discount rate for valuing the entire company or average risk projects.
And the source notes that the optimal mix of debt and equity, the capital structure, varies by industry.
Definitely. It reflects a trade-off. Debt offers tax benefits. Interest payments are usually tax deductible, which can lower WACC. But too much debt increases the risk of financial distress or bankruptcy, which is costly. Stable businesses like utilities can typically handle more debt and benefit more from tax shields than volatile tech companies.
Okay, so earning returns above WACC is the key. But the source says there's more to value creation than just that.
Yes, simply beating the cost of capital today isn't the whole story. Two other critical factors drive long-term value: duration and reinvestment.
Duration, like how long something lasts.
Exactly. In this context, it means how long a company can sustain earning those excess returns above the cost of capital. This is all about competitive advantage.
So companies with strong brands, patents, network effects, unique technology, things that create barriers to entry, they can maintain high returns for longer. They have longer duration.
Precisely. A company whose high returns are quickly competed away has low duration. Sustainable competitive advantages create long duration, which is incredibly valuable.
And reinvestment.
This is about what the company does with the profits it earns, especially those excess profits earned above the cost of capital. If it can reinvest those profits back into the business at similarly high rates of return, that drives profitable growth and compounds value creation dramatically.
So it's not just earning high returns, but earning them for a long time and putting those profits back to work effectively.
That's the trifecta. The source uses tables, 44445, to illustrate this powerfully. They show how market value relative to book value, a proxy for value creation, is highest when 1. Return on equity, ROE, is well above the cost of equity. 2. That gap persists for a long time duration. And 3. A high percentage of earnings are reinvested back into the business.
And critically, if ROE just equals the cost of equity,
then the market-to-book ratio is just 1. No value created beyond the accounting book value, no matter how long it lasts or how much you reinvest. You're just treading water financially.
the BP example drives this home too, showing value destruction.
Yeah, their stock price rose from 2003-2008, when their return on capital, ROC, was consistently above their estimated cost of capital they were creating value. But post-2008, their ROC fell below their cost of capital.
And the stock price stagnated, even though they were still paying dividends.
Right, because shareholders expected a certain return given BP's risk, implied by the cost of capital. When BP failed to deliver that return, they were destroying value relative to those expectations. The dividends weren't enough to offset the shortfall in operational returns.
The source also flags some common mistakes people make when thinking about cost of capital. like applying the wrong rate.
Yes, this is crucial. The appropriate discount rate, cost of capital, for evaluating an investment decision should reflect the risk of that specific investment, not necessarily the overall company's average WACC or who is providing the money in using internal cash versus borrowing.
So if a big, diversified company with a high average WACC is considering a project in a very stable, low-risk part of its business,
It should use a lower discount rate for that specific project, one that reflects that project's lower risk. Using the company-wide WACC would be too high a hurdle, potentially causing them to reject perfectly good, value-creating, low-risk project. Vice versa for high-risk projects.
misapplying the cost of capital leads to bad investment decisions.
Got it.
What's the other myth? More debt always lowers WACC.
That's a common simplification. Initially, adding some debt can lower WACC because interest payments are tax-deductible, making debt seem cheaper than equity. But as you add more and more debt, the company becomes riskier. This increases the required return cost for both debt holders who demand higher interest rates and equity holders who demand a higher return for the increased financial risk. Beyond a certain point, the rising costs of potential financial distress outweigh the tax benefits, and the overall WACC starts to increase. There's an optimal, value-maximizing level of debt, not just more is always better.
The quote from equity analyst Alberto Moll seems to tie this all together nicely.
It does. He confirms, from a practical market perspective, that the key long-term driver of shareholder value is exactly what the framework says: earning excess returns on capital, returns above the cost of capital. His analysis of Corning Glass was all about disagreeing with the market's expectation about Corning's future ROC relative to its cost of capital. He thought they'd do better, hence the buy rating.
So, the big picture for value creation. It's all about investing capital to earn returns that beat the cost of that capital, considering the risk involved. Doing that consistently over time, duration, and reinvesting effectively are the keys to compounding wealth.
And for you, our listener, this provides the core framework for evaluating any business or investment. You can now ask the critical questions. What's the expected return? What's the risk, beta? What's the hurdle rate, cost of capital? Is the return likely to beat the hurdle? For how long? And how well are they reinvesting? This is the engine of wealth creation.
Okay, absolutely fundamental stuff. Now, assuming a company is successful at creating value and generating cash, what does it do with that cash? This brings us to capital allocation, Chapter 6, the CEO's big decisions.
Exactly. This has become, as the source notes, a central preoccupation for CEOs and CFOs today. Once you're generating significant free cash flow, deciding how to deploy it is critical.
And making bad decisions here can be disastrous, right?
Yeah.
Wiping out value created elsewhere.
Hugely destructive. Poor capital allocation choices like ill-conceived acquisitions, M&A, or badly timed share buybacks can destroy enormous amounts of shareholder value, potentially outweighing years of solid operational improvements.
The source provides a kind of decision tree for this, figure 614. What are the main options when a company has excess cash?
Broadly, there are three paths. 1, retain the cash, just keep it on the balance sheet. 2, invest in the business. This can be through organic expansion, building new factories, R&D, internal projects, or inorganic growth via M&A, buying other companies. 3, distribute to shareholders. Return the cash to the owners, typically through dividends or share buybacks, stock repurchases.
Let's look at investing in the business first. The build versus buy decision.
If you build organic growth, the rule is the same one we've been discussing. Invest in projects with a positive net present value, NPV. Only undertake projects expected to earn more than their cost of capital.
The Heineken Mexico factory example is interesting here. The CFO looked at strategic factors first.
Right. Lawrence DeBrew looked at the strategic rationale, large market, growing GDP before diving deep into the NPV calculations. The idea is that strategic analysis helps identify which potential projects are most likely to have positive NPVs worth investigating further.
Okay, so that's build. What about buy, mergers and acquisitions, M&A?
M&A is the inorganic route. It seems faster, instantly acquires scale, technology, or market access. But the source reminds us it's packed with perils, revisiting some pitfalls from the valuation chapter.
Like information asymmetry. The seller always knows more about the business being sold.
Always a risk. Buyers do due diligence, but sellers might hide problems or paint an overly rosy picture.
And the risk of overpaying.
Huge. Buyers might exaggerate potential synergies, the 2 + 2 = 5 idea from combining companies. They often underestimate the costs and difficulties of integrating the two businesses. And remember, the incentives investment bankers advising on the deal and the company's own deal team often have strong incentives to just get the deal done, which can lead to overpaying. Often, even if synergies are real, the buyer pays so much that all the value goes to the seller's shareholders.
Integration risk sounds tough too. Merging cultures, systems, people.
It's often the hardest part and frequently underestimated. The source mentions Biogen acquiring Convergence Pharmaceuticals and keeping the teams somewhat separate initially to preserve their entrepreneurial culture, highlighting how tricky integration can be.
What about conglomerates, big companies buying unrelated businesses?
The source touches on why they were historically popular, ideas about diversification benefits or exporting a lower cost of capital to acquired firms, but often fail in practice. Problems include agency costs, managing diverse empires is hard, and misallocating capital by applying the wrong, often average, cost of capital to businesses with very different risk profiles.
Okay, so investing in the business, build or buy, is one option. What about the other main path, distributing cash back to shareholders, dividends versus buybacks?
Right. Now, the source makes a really important theoretical point first, revisiting the idea of value neutrality from the perspective of financing and distribution decisions, assuming perfect markets, no taxes, no transaction costs, perfect information.
Value neutrality, meaning
Meaning, in that idealized world, the specific mechanism a company uses to return cash to shareholders, whether it pays a cash dividend or uses the cash to buy back its own stock, doesn't actually affect the total value of the company or the total wealth of its shareholders.
how does that work? The source uses those market-based balance sheet examples, figures 6.3 through 6.9, to show this, right?
Exactly. Let's walk through it simply. Dividend. Company pays cash out. Cash on the balance sheet goes down. The total value of the company's equity goes down by the same amount. So the stock price per share drops by roughly the dividend amount on the ex-dividend date. Shareholders get cash, the dividend, but their remaining shares are worth less. Their total wealth, cash dividend plus value of shares, remains unchanged. Buyback. Company uses cash to buy shares in the open market. Cash goes down. Total equity value goes down by the cash spent. But the number of outstanding shares also goes down. The result, the share price should theoretically stay the same. Shareholders who didn't sell see their percentage ownership increase, but the total value of their unchanged shares is the same as before the buyback. Fewer shares outstanding, same price per share, lower total equity value. Total wealth is unchanged.
So theoretically, it's just moving value around between the company and shareholders, or changing the form of the value, cash versus stock, but not creating or destroying it.
In a perfect market world, yes. The source shows similar neutrality for other actions like issuing new equity, cash up, equity up, share count up, price per share theoretically unchanged if issued at fair value. Stock splits, share count up, price per share down proportionally, total value unchanged. Or even leveraged recaps. Borrowing money to buy back stock debt up, equity down, total value might change due to tax shields, but the mechanics are neutral.
Even VC funding rounds, like a Series A or B.
The principle holds if done at fair value. New cash comes in, increasing total company value. New shares are issued to the new investors. Existing shareholders get diluted, their percentage ownership goes down, but the value of their stake should ideally increase because the overall pie is bigger. Value neutrality holds for the transaction itself.
Okay, that's the perfect market theory. But the source stresses that in the real world, these decisions do matter. Why?
Because the real world isn't perfect. Market imperfections make these choices significant. Taxes, dividends and capital gains, from selling shares after a buyback might push the price up or just selling, are often taxed differently for investors. Tax rules influence preferences. Information signals. Actions speak louder than words. Issuing new stock might signal management thinks the shares are currently overpriced or that they need cash because internal projects aren't generating enough. Buybacks can signal management believes the stock is undervalued, though the aggregate data in Figure 6.2 suggests managers aren't consistently great at timing buybacks. Agency considerations. This keeps coming back. If a company just sits on a huge pile of cash, it can signal a lack of good investment opportunities. Or it might indicate agency problems managers wanting a big safety cushion for themselves, rather than returning cash to owners. Large cash balances attract activist investors who push for distributions.
Like the Apple example. Holding tons of cash brought activists like David Einhorn knocking.
Exactly. Returning cash via dividends or buybacks can reduce this agency conflict by getting cash out of managers' discretionary control and back into shareholders' hands.
So the how matters because of these real-world frictions.
Definitely. The Heineken CFO, quote, reinforces this. Paying dividends doesn't mean you have no good projects. It's about finding the right balance. And investor preferences for dividends versus buybacks can also shift over time.
The Biogen buyback chart, figure 613, seems to illustrate the complexity. They bought back a lot of stock.
At pretty high average prices, $303.66. And the stock price did end up higher, $325 by the end of the period shown. Does that mean the buyback was a success?
Hard to say just from that, right? What if the stock would have gone up anyway? What else could they have done with that cash?
Exactly. It shows that evaluating the success of buybacks after the fact is really tricky and subjective. It's not automatic value creation.
And the David Einhorn versus Apple iPref proposal is a fascinating example of trying to use financial engineering.
Oh, yeah. It's a great case study in the source on potentially flawed financial logic, even from smart investors. Einhorn proposed Apple distribute a new class of preferred stock, iPref, alongside its common stock, arguing this would somehow unlock value by separating Apple's earning streams, which the market might value differently, assign different PE multiples to.
Sounds complicated, but potentially clever.
It sounded clever, but the source argues it's fundamentally flawed based on that value neutrality principle. Why? Because simply repackaging or splitting up the existing underlying cash flows of the business shouldn't magically create new value in an efficient market. The total value should just be the present value of the total expected future cash flows, regardless of how you slice them up legally or financially.
So Einhorn's argument ignored basic value principles.
The source suggests so. It's a powerful example of how seemingly sophisticated financial maneuvers might sound appealing, but ultimately violate the core idea that value comes from underlying cash generation and profitable investment, not just financial engineering.
Okay, so wrapping up capital allocation. It's a crucial management function. Choose between retaining cash, investing, build positive MPV projects, be wary of M&A pitfalls, or distributing cash, dividends, buybacks. While theory suggests neutrality for distribution methods, real-world taxes, signaling, and agency issues make these decisions highly consequential.
And for you, our listener, this helps you understand the why behind corporate actions like dividend changes, buyback programs, or M&A deals. It gives you a framework to critically assess whether these decisions seem strategically sound and value-creating, or potentially driven by flawed logic, misaligned incentives, or empire building.
Wow. Okay. We have really covered a massive amount of ground in this deep dive. It feels like we've journeyed from the outside in.
We started by tackling that initial intimidation, didn't we? Realizing finance is fundamentally about information, incentives, and the principal agent problem.
Then we learned the language using ratios to analyze performance, uncover strategies, and see stories like Timberland's turnaround or near-death experience.
We adopted the core finance perspective, shifting focus from accounting profit to the vital importance of cash flow, especially free cash flow, and the absolute necessity of discounting future value using the time value of money and NPV.
We navigated the complex financial ecosystem, understanding the roles and, crucially, the incentives of the buy side, the sell side, analysts and companies, and how asymmetric information shapes their interactions.
We unlocked the engine of value creation itself, the imperative to earn returns above the cost of capital, with risk, beta, duration, and reinvestment being key amplifiers.
We wrestled with valuation, recognizing it as both an art and a science. Seeing DCF as the gold standard, but being acutely aware of the limitations of shortcuts like multiples and the behavioral biases that could lead to costly mistakes.
And we finish with capital allocation, perhaps the most critical job for a CEO, understanding the choices between investing and returning cash, and why those choices matter profoundly in our imperfect real world, despite the elegance of perfect market theory.
The source material really aimed to build intuition, and hopefully this discussion has helped solidify some of that for you.
The hope expressed in the source, and certainly our hope too, is that getting a handle on these fundamental intuitions empowers you to engage with financial topics confidently, and maybe more importantly, with ongoing curiosity for the rest of your life.
That's the perfect word for it, curiosity. Keep asking questions. Think of this deep dive not as the end, but really as a solid foundation to build on.
So, as a final thought for you to take away and perhaps mull over, let's circle right back to where we started. We've established that finance is fundamentally about information and incentives, and that managers, agents, almost always have more information than the owner's principles they're supposed to serve, given that inescapable reality.
How can you, whether as an investor, an employee, a manager yourself, or just an informed citizen trying to make sense of the business world, how can you best use the tools and perspectives we've explored today? The ratios, the cash flow analysis, the understanding of incentives, the valuation frameworks to cut through the noise, the jargon, and the often conflicting interests to get closer to understanding the true financial picture of a company or a situation.
It's a challenge, no doubt, but hopefully you now have a better toolkit to approach it.
A complex question for a complex world indeed. Thank you so much for joining us on this deep dive into the core principles of how finance works, drawing heavily from Mihir Desai's insights. We truly hope it was valuable, maybe made finance feel a little less like a secret language, and perhaps even sparked some new questions for you to explore.
Thanks for listening. Visit our library and subscribe below for more book summaries. This has been a Sprint Reads production.